quite interesting that I think that in many occasions the wholesale market, the institutional market, is often trading against the retail market at the very same moment where what one is buying, the other one is selling. For example, if you think about a support line, for example, you might think that, well, this support line may hold. Also, the institution may think this support line may hold. The support may be the day's low, the month's low, the pivot low, something like that. They're seeing the same thing as you. Now, how might you react to this? Well, you want some confidence. So you might see that the approach to the support line is weakening, so the candles are getting smaller and the bodies are getting smaller and the volume is lightening. And then you have a nice white candle, which gives you the feeling that we've reversed up and the close is now well off the opening, and so it's turning. And you might, as a retail trader, say, if it follows through on the next candle, I'm going to buy and enter the market. I've got a very obvious place for a stop, which is below the low of the recent candles, and that's where I'll enter there. Now, what you don't realise is that the institutions, because of their size, they could never do that. They couldn't wait for that late stage. If they start buying at that point, they'll push the market away from them and they won't have got enough size on board, enough position on board, and the market will have already run away. So they've already had to have participated. So as the market comes and starts to look as though it's going to hold and not fail, they will be the buyer. Actually, they caused the white candle that you're now seeing as the trigger, and they've already started to buy. It's risky because they're buying early. They haven't got the confidence that you've got, but they have to participate earlier than you. And so they are buying, and they will possibly be selling, having already bought at the very moment that you are buying.